Let's do this. So now we're getting into the application section of the class. Built a solid foundation and present value, future values, understand interest rate dynamics, capital market dynamics. Now let's underwrite some transactions. Okay? This is called the underwriting process. Okay? This is very simplistic. What I'm going to do is basically train you on how to underwrite transactions. What I'm not going to do is I'm not going to get into the detail of building the pro forma income statements around these transactions. Okay? You're learning a lot of that, or you've learned a lot of that in your financial accounting class. And you accounting majors, do you guys take financial statement analysis? Do you have a class on financial statement analysis? Yeah, okay, when you do a master's degree, or you'll probably do a whole semester on financial statement analysis. This course could also, or these problems could also be a class in securities analysis, a whole semester. It could also be a whole semester on real estate finance and investments. It could also be a component of the new venture finance class that you're taking here. Could be a securities analysis class, could be a mergers and acquisitions class. So these are just the basic underwriting fundamentals. Okay? And we're going to underwrite the transactions. And then the very last, I think it's the very last problem, which is this one on page 7, is ties right back into the capital budgeting chapter, the investment decision making chapter, using net present values and internal rates of return and break-evens, but I've designed a investment decision-making matrix that kind of pulls it all together and shows how the present values and the net present values and internal rates of return and break-evens, how they all tie together. So if you know one, you know the other three. Okay? And when you're in these meetings talking about acquisitions or investment underwriting, everybody's talking at the same level. We're talking the same thing. And you could be switching back and forth between NPV, PV, IRR, break even. It really depends, on what it is. So these are kind of the scenarios. The first one is a venture capital or a private equity case study. What we're going to do is we're going to buy a technology company. Do private equity firms or venture capital firms, does everybody know what a private equity firm is or a venture capital firm is? Does everybody know what those are? Venture capital firms basically are all on Sand Hill Road. Okay, we're basically the heart of venture capital that funds emerging technology companies, and they basically put up the equity and put up the money to basically fund these technology companies that need to go from their seed stage or their initial round stage, and they need to raise between 25 and 50 million bucks. And they could even be more than that. But usually the range of new venture capital is between 25 and 50 million bucks. So they've been bootstrapping it for a while. They've raised maybe a couple rounds of debt, convertible equity. Now they need a venture capitalist to come in and fund the company to take it into the early majority adoption phase of the scaling of the company. So they need a ton of capital, and they need a ton of experience in the management team to be able to handle that kind of growth. Okay, so we're either a venture capital firm or a private equity firm. And the private equity firm will buy the same type of company, but the objective is not to take the company public as an initial public offering. They want to keep the company in their private portfolio as one of their divisional lines within their portfolio of companies that they incubate. Their exit is not to go IPO. Theirs is to hold basically a portfolio of companies within their portfolios and manage that company. And if there is an opportunity to spin it off or sell it off at some point in time, they will do that. But they're private, both of them are private firms. They both act basically the same. They underwrite these companies, they'll fund the companies, or they'll buy them out. Okay, so the private equity firm is looking to buy them out. The venture capital firm is looking to fund them. Okay, and we're going to buy a tech company since we're in Tech Central. As we know, there are 4 main valuation methodologies. For this case study, we are going to use EBITDA, earnings before interest, taxes, depreciation, and amortization. If we were buying a larger firm, which we're going to do later on, we're going to use earnings as the numerator and the cash flows to be able to do the valuation. But since we're dealing with newly started companies, we're using free cash flow, and we're going to use EBITDA as the free cash flow metric, okay, for the target company. So we are the acquirer, and we've identified a company as the target that we are going to buy, okay? The following are the case study assumptions. One, the models that you're going to use: perpetuity, Gordon growth, the multiple approach. Oh, and in this example, please note that we've actually bought multiple companies, sold multiple companies over the last 2 years, and the multiples that we've come up with, the sales price divided by the EBITDA, the multiple, we've been able to identify transactions that have sold at multiples of 55, 45, and 22 times their free cash flow, okay? And then we're going to use the discounted cash flow methodology. The assumption is this is a small tech startup company in the software consumer product space. It's also plans on going global at some point. It's pretty easy to scale and distribute consumer software products via the internet and other social channels. It's pretty easy to distribute that stuff on a global basis once you've gone domestic. It's very easy. It's just IT, basically. Being bought by, so the startup company is being bought by a private equity or venture capital firm. Also shown are the calculations for the valuations utilizing the above method. So here's the data right here. There's not a lot of data, but it's enough data to be able to calculate the valuations using the 4 methodologies, and then we will reconcile those methodologies to identify the true intrinsic value that we've come up with for the firm, and then decide, do we want to buy the firm or not. Okay. So we're going to use perpetuity, Gordon growth, multiple. The question is, what is the intrinsic value of the target company? Using DCF, what is present value, net present value, internal rate of return, and break even? Would you accept or reject the project? If the NPV was negative, what 4 iterations would you go through? If you still could not get the project NPV positive, what would be your last scenario? And what would be the net present value? So this is valuation, this is capital budgeting, all rolled into an application, okay? So let's get started. So let's start with the first valuation methodology. Which one are we going to start with? Perpetuity. Okay. And then what do we need to calculate the intrinsic value using the perpetuity model? You can always look back at your exams and look at the valuation and then tell me, you know, remember in the exam I had you list out the intrinsic valuation formulas. So what do you need to calculate the, or maybe just give me the formula and we can go through it. So what's the formula for coming up with the intrinsic value using the perpetuity model? Now what I would be doing is looking through my notes.
Cash flow over yield?
Yeah, so are we going to use last year's, this year's, or next year's cash flow? Last year's, this year's, or next year's cash flow?
Next year's.
And this is where I drive my students crazy, because I ask the question over and over again to see if I can get some engagement from some of the students that are totally disengaged. Okay. Which year?
Next year's.
Perfect. So I got cash flow next year, and then what am I going to do with that?
Put it over the I, the...
Yeah, what's the I?
the interest?
These are the ors.
Expected.
Say it again? No, you got it.
Expected rate of return.
Your expected rate of return. Okay. It's going to give me the valuation for the perpetuity. Got it. So what's next year's cash flow? Do we have anything? And you should be looking at this and studying this. The answer is not up here on the board. The answer is on your sheet. Okay. A lot of students, what they'll do is they will wait for the answer to be provided to them on the board. They will not go through the learning process of trying to agonize what I'm asking. That's how you learn. Okay. When you wait for somebody to put the answer on the board, then you memorize the answer. You don't go through the mathematics in your brain. So you're not training the mechanisms in your brain to solve the problem. You're just looking at for the answer. That's not how you learn. So what do we need? Does it tell you here anywhere on the sheet here? Right here. On the sheet, does it tell you what next year's cash flow is? Does it tell you on the sheet, right here? Or do you have to calculate? You have to calculate. So how do I get next year's cash flow? I take,
The free cash flow and multiply it by your,
yeah, and what year am I using?
well, next year should be T plus one.
Yeah, well, that's what we're calculating.
So you use the current year,
Exactly. And what's the current year EBITDA?
20 million.
Got it. So 20 million. And then how do I get next year's? What do I have to do to it to get next year?
You'll multiply it to
And does it tell you what the growth rate is in the first year?
Yeah, 3%.
Got it. And then this is gonna be what? 1.4. Got it. So what's 1.4 times 20 million? Again, you need your calculators to do this unless you can do it in your head. Everybody's gotta break out the calculator, or your spreadsheet, and do the calculations, because I need you to practice how to do this stuff. 28 million, thank you. Got it, awesome. So we got the first piece. 28 million. Okay, and then is there, in this, the assumptions, does it tell us what our return expectations are on all of these transactions that we underwrite? What do we want, what's our return that we want?
30%.
30%. So what do I divide the 28 million by?
0.3.
0.3. Got it. So what's 28 million divided by 0.3?
93,332,000.
93 million, just round up. Okay, so I got one person, this is the way it usually works in the room. Because one person will tell the answer, but I need at least 3 other people to verify. Okay, I can't just take one person's word for it. Okay, I need validation and verification. So what is 28 million divided by 0.3? Do you have a calculator? What is it? 93 million? Okay. Got it, thank you, I just need verification. What's the second valuation methodology? Gordon Grove. Got it. Or constant growth. And what's the Gordon Grove model?
93 million.
Cash, future cash flow.
Cash flow T plus 1 divided by what?
Expected rate of return.
Got it.
Minus G.
What's G?
But
What's the G? Good?
great.
Great? Got it. And we know what the, what's next year's cash flow? 28 million. Got it. And what's our expected return? 0.3. And does it give you a constant growth rate? An initial or going in growth rate? 15%. 0.15. 0.3 minus 0.15 gives you 0.5. It's 28 million divided by 0.15. Do it in your calculator.
187.
Do you have a calculator? What is it?
187.
187?
187 million.
Yeah.
Got it, thank you very much. What's the, okay, what's the next methodology? Multiple approach, excellent. And what's the equation? What's the equation for the multiple approach?
It's the CF T plus 1,
Future cash flow, T plus 1.
and then times the M of the T plus 1,
Multiple,
multiple of the T plus 1 but that varies if you're doing perpetuity or Gordon Grass.
Yeah, we're not gonna do that because
Okay.
this is the, multiple approach, got it. All right, so what, what's next year's cash flow? 28 million. Got it. And do they give us the multiples? Do they give us any multiples? Or do we gotta calculate? Or do we gotta call Steve at Kleiner Perkins and ask him for some multiples for high-tech software companies that have basically been bought over the last year? Do we need to call Steve?
Don't we have our multiples from 22, 24, and 55?
Yeah, exactly, so we already know this. 55 times,
Specific figures.
44 times, and 22 times. So over the last year, there's been 3 transactions that have gone down. One was, one bought the firm at 55 times their free cash flow, the other bought it at 44, the other bought it at 22. So we have a range or a sensitivity of multiples to be able to calculate the intrinsic values using the multiple approach. So what's 28 million times 55? What is it?
1.54 billion.
Yeah, it gives me 1,000, but I'll do it in billions. 1,000.
1,540,000.
1,540,000,000, like that,
Oh,
or
yeah,
basically
million.
1.5 billion.
Yeah.
Okay, and what's 28 times 44?
1,232.
232 million or 1.2 billion. Do these unicorns, do these companies, do they get bought for billions of dollars? Do these software companies get bought for billions? Yes, they do.
Yes.
They do. Yeah. Somebody came into my office the other day, told me about a Stanford student who had like 5 master's degrees in engineering and data analytics and computer science and stuff, and she just sold her company for like $1 billion. Yeah. Can you imagine you're done? What's 28 million times 22? That's what, you should be thinking that, you need to think this big, okay? You need to think this big. What is it?
616.
No, I get told all the time, I want to go work for BlackRock and Facebook and Salesforce, and these companies are doing billions of dollars in revenue a year. You gotta start thinking in those terms. Okay, we got it. So right off the bat, which one, you know, if your investment committee board chair said, okay, you know, which one of these multiples do you think we should use right off the bat to get an estimate of the intrinsic value using the multiple approach? Which one would you probably recommend right off the bat? Would you take the best case scenario, the worst case scenario, or a more probable scenario? Midpoint.
One no.
Yeah, probably midpoint. Okay. And then as you do more due diligence, you know, you may oscillate up and down, but this actually sets a range. And you're better off just picking a midpoint. Okay. We already have this one too. We also have this one too. So we already have 3 of the valuation methodologies. What's the next methodology?
Discount chapter.
Yeah, DCF. And what's the holding period?
3.
3 years. This is how I do it, 3, like that. Need an extra year. I go terminal value. RTV. So I set it up right there. Okay. Do we know what the expected return is? Let's do the easy stuff first. Do we know what the expected return is? 30. So what do I divide this by? It's going to be 1.3 to the what?
To the 1.
1. This is going to be 1.3 1.3? What's 1.3 squared? 1.3 squared.
1.69.
Yeah, you need to practice your exponentials. What is it?
1.69,
Yeah, so just round it up. 1.7.
1.7.
And then what's 1.3 cubed?
2.2.
2.2? Nice.
Second it.
Awesome. And then what I do is I go right down here and I set this up. Now you may be doing a 3-year holding period. I mean, if we're gonna go in and we're gonna basically buy out the company, restructure the company in 3 years, expand its distribution channels, maybe replace the management or keep some of the management, scale the income significantly, and then spin it off as an IPO or sell it to another private equity firm, we could do that too. Got it. All right. So do we know what the first year's cash flow is gonna be? What's the first year cash flow? It's a trick question. What's the first year cash flow? Yeah, who said it? Got it, say it out loud.
20 million.
No, that's last year's.
28 million.
That's okay. You're engaged, that's awesome. Okay, so what's the next year? How do I get a year 2? Okay, how do I get year 2?
You do the 28 million times 1.28.
Got it, does everybody follow? Everybody get that? It gives you right there what the growth rates are over the pro forma period. So it's 28 million times 1.28. So what is 28 million times 1.28?
36 million.
36 mil. Got it. And how do we get year 3?
Same thing, just times 1.25.
1.25. So what's 36 million times 1.25?
35 million.
35 million. Is that right?
Yeah.
How can I do that? How's 36 million times 1.25 be 35 million?
Yeah.
It doesn't work.
1.28, 1.25.
The growth rate.
But yeah, the growth rate.
1.28, 1.25, got it. 36 million times 1.25 is what? 45. Got it. This will all be in Excel and stuff like that, but if you make a mistake in Excel and you give them the wrong numbers, we're gonna be in trouble. Okay. Yes, sir.
So for year 3, what is the, what's the percent that we
Well, if
use?
this is right, then it's 25%, so it tells you that the year 3 growth rate is gonna be 25%.
So for the middle one, we do 28 million times 28%?
Yes, we did 40 there, right, to get this one. Then we grow this at 28 to get year 2. Then we grow it at this at 25% to get year 3. Got it? Okay, perfect. And then what do we do? Is that it? Do we just discount this back to the present to get the present value, and that's the value that we're going to use? What do we need to do next?
Another one.
Yeah, we got to grow it out one more year. And what's the growth rate?
Yeah.
What do we grow it out by?
40%.
No. What is it? Say it, go ahead, say it. 15%. Got it. So it's 1.15. Got it. So what is 45 million times 1.15? These are all correct, right? Are these all correct? Are you checking the numbers to make sure that they're correct? Thank you. So what's 45 million times 1.15? 52?
Yep,
52, I got 2 confirmations. Got it. Now what do I do? Well, I have to ask you, are you going to assume that the cash flows are going to grow at a constant rate forever or remain flat into perpetuity? What kind of company is this? It's a tech company. What's the probability that the tech company's free cash flows are going to grow at a constant rate forever, as opposed to remaining flat? From year 4 on, do you think that the cash flows are going to remain flat from year 4 on, or do you think they're going to grow at a constant rate? Come on, analysts, you're the underwriters here. You have to make a decision. Either you're gonna be conservative or you're gonna be realistic.
It's
The company-
gonna remain flat.
And why would we buy a company whose cash flows would remain flat forever?
We wouldn't.
We wouldn't, so
They
we're,
grow at a constant rate.
exactly, and what's the constant rate that we're gonna, that they're gonna grow? What is it? Does it tell you? Here, does it give you the growth rates, the free
10%?
cash flow growth, exactly 10%. Okay, and what's our expected return for the terminal period? What's the expected returns for the terminal period?
40%.
40%. So 0.4 minus 0.1 gives you what? 0.3. Okay, so here's an intuitive theoretical question. Why would I use a higher terminal discount rate than the going in discount rate? Why would I use a higher expected return for the terminal calculation than for the going in? Why would I use a higher expected return for the terminal value calculation as opposed to the 30% for the going in for Gordon Growth? Why am I increasing the expected return from the going into the terminal? Why would I ask for a higher rate of return on the terminal value calculation?
You're expecting to increase the value of the company?
No, I'm looking more for, do you understand the relationship between risk and return? If I'm asking for a higher rate of return, then I'm gonna assume what, higher or lower risk?
Higher.
Higher risk. Are these tech companies high risk? Consumer product software company in a startup stage, would that be a low risk investment? That would be highly risky. Does technology change very rapidly?
Yes.
Yeah, is that risky to the tech company?
Yes.
Yeah, and are these spaces highly competitive,
Yes.
especially consumer product software spaces? Yeah, so you're looking at extremely high competition and high technological obsolescence going forward, so I'm gonna need to be compensated for that risk. So I'm gonna ask for a higher expected rate of return. What about the growth rate? Is there a difference between the going in growth rate assumption and the terminal growth rate assumption?
Yeah,
Yeah. Am I increasing or decreasing it?
decrease,
Decreasing it. Why would I slow the growth rate?
because you can't expect to grow as fast later on as you did right at the beginning.
Exactly. Increased competition, other factors, so you need to come down on the growth rates. Come up on the discount rates, come down on the growth rates. Okay. So what's 52 million divided by 0.3?
173 million.
How much?
173 million.
173 million. Got it. Okay. So that's our terminal value. And what do we do with the terminal value? What do we do with the terminal value?
We
Just leave it
stick-
out there and let it hang out?
We stick it out for the year 3.
Yeah. So basically, you're gonna add it to the year 3 cash flow. What's 173 million plus 45 million? So what's 173 million plus the 45 million?
218.
218. Got it. Okay, awesome. What do we do with the 218? What do we do with the 218? What do we get? Gabby, do you know? Yeah, exactly. And you're gonna take the 218 million divided by the 2.2. Okay. And what's 218 million divided by 2.2? How much? 99. Got it, excellent. And what about 36 million divided by 1.7? What does that give us?
21.
Okay, and what do we do next? What's the next procedure?
28 divided by 1.3.
Exactly, 28 divided by 1.3, and what does that give us?
52.
2 million, got it. And what do we do with these discounted cash flows? You add them up, and what do you get? 142 million. Got it. Okay, so we got, this is interesting, isn't it? I run the discounted cash flow methodology, it comes up with 142 million. I run the Gordon growth model, I get 187 million, and when I run the perpetuity model, I come up with 93 million. Yes, sir.
Just one quick question for the, so for year one, we multiplied 28 million times 1.28.
Yeah,
And then the second one is 28 million times 1.25.
yes.
Okay. And then so the last one would be 28 times 1.15.
Yeah, to get the fourth year. Get CFO. We have to grow it out one more year.
So why is 45 bigger than 36 when the number is higher? 1.25 is greater than.
36 times 1.25 gives us 45.
Oh.
And then the 45 times 1.15 gives us the 52. Okay. That's cool. Thank you. I just want to make sure you're getting it. All right. Yeah,
So
go
use
ahead.
that same rate, the 1.15, when multiplying into to get the 52 million. So you said, right?
Yeah, you take the 45 times 1.15
Yeah.
and you get the 52.
Just making sure. Thanks.
And then you're going to use the terminal expected return minus the terminal growth rate gives you 0.3 into the 52 million is going to give you 173 million. And then the 173 million plus the 45 million gives you 218. And then you divide the 218 by the 2.2 to get the discounted cash flow. Okay? And then you sum it all up. So here's the problem here. So I get 142 million for the discounted cash flow. I get 187 million for the Gordon growth, and I get 93 million for the perpetuity model. And how much is the seller of the company wanting to sell this company for?
Too high.
It's my
200.
mistake.
200. So what would be my net present value using those three methodologies? If they're asking for 200, I get 90. I'm coming up with, we're coming up with 93, 187, and 142. My net present value is going to be positive or negative? Negative. Are we going to accept or reject it? We're going to reject it. So based on these three simplistic methodologies, we would reject this project. We would reject the acquisition. But that's not the true reality. Actually, these three methodologies are very simplistic, and we wouldn't even use this in most cases if we were working for the private equity firm or the venture capital firm. We may do it just for posterity purposes, but we would be using the multiple approach. Because we know that we can sell these firms, and this is what these firms are transacting at in the marketplace right now. So if we're going to buy them, we're going to have to buy them at a multiple of free cash flow. So these become just theoretical exercises, or maybe just floors in the valuation. But if we use those three, we would get a negative net present value, and we would reject it. But if we use a multiple approach based on the actual transactions that have occurred over the last year, we're coming up with a $1.2 billion valuation. What's our net present value? Is it positive or negative? It's positive. Is it significantly positive? Yeah. So what's our internal rate of return on this? I mean, we would get a zero net present value, right? We would be getting a zero net present value. If the valuation and the acquisition price were the same, we would be getting our 30%. But we're getting a net present value of how much? 1,232 minus the 200. It's 1,032,000,000. This is our cost. This is the value under the multiple approach. So we're getting a net present value of 1,032,000,000. What do you think? Just guess. What do you think? What do you think our IRR is on this thing? 300,000, something ridiculous. Yeah. So maybe you can do the calculation, but the IRR is off the chart on this thing. So would you do this acquisition? Would you buy this company for 200 million if it's worth 1,232 million? Yeah,
Yeah.
absolutely, totally. Yeah, you would totally do it. Okay. All right. Why don't we go over here? Why don't we move the camera over here? And we'll walk through the next methodology, or the next stage of this. Would we reach break even anytime soon? If we bought it for 200 million, how long would it take us to reach break even? We bought it for 200. Start subtracting out the cash flows. We bought it for 200 million.
7.
It's 200 million divided by 28, divided by 36, divided by 45, divided by 50. Would we reach break even in less than 3 years on this? Yes or no? No. So is break even a good metric for investment decision making in this type of situation? So break even really doesn't work, DCF doesn't work, Gordon Growth doesn't really work, perpetuity doesn't really work, it's really the multiple approach. Okay, would be the investment decision making metric that you would use, or for the valuations. All right. So what did we decide? Were we going to accept or reject the project? Accept it. Okay. But let's say we don't have a multiple approach. Let's say we don't have a multiple, and we just have to rely on the 3 other methodologies. What value would you come up with? If we were just using these 3 methodologies, what would be your valuation? Would you assume that the cash flows would remain flat forever? Would you assume the cash flows would remain flat forever? No, so actually perpetuity is not a good model. DCF is a pretty good model. So we may use DCF. You get 142 million there. And then Gordon Growth assumes that the cash flows are going to grow at a constant rate, so that's a pretty good model too. So if you had these 2 models, how would you reconcile the 2 to come up with an intrinsic valuation? How would you do it? The board asks you. I see your methodologies, I see how you did it, I understand why you didn't choose perpetuity. You're coming up with 187 million for Gordon Growth and 142 for discounted cash flow. What's your final intrinsic valuation?
What kind of business you're investing in?
This is the tech company. But the board's asking you to reconcile between the 2 methodologies, and how would you come up with a point estimate valuation? This is a total logical.
Wouldn't you add them up and then divide by 2?
You could take the average of it, and what do you come up with? If you were to take the average between the 2, what would you come up with?
164.45.
So 165 million? Got it. So that's one way to do it. Another way to do it is to say, okay, this is such a simplistic model, let's just use the discounted cash flow. Okay, but I'm going to use your method and just take the average between the 2, because that is a way to do it. So we get 165 million. And what was the acquisition price? I'm going to go back over here. What was the acquisition? 200 million. So I got it. 200 million acquisition price. If you can move the camera back over. Thank you. And then what was our intrinsic value that we came up with?
165.
165. So what's our net present value? So what's the NPV? What's the net present value?
Negative 35 million.
Negative 35 million. Got it. So this basically is the first iteration, right here. This is the first iteration. It's just a basic underwriting. And would we accept or reject this?
Reject.
You would
Reject.
reject it. iteration too. Got it. So what could we do, test question, this is a tough one. I go to the board, we go to the investment committee, they go, great, you guys did a great job of underwriting the deal in the short time period that we had to basically, underwrite this thing. We really want this company. We really want this company. And you're telling us that, we shouldn't buy it because the NPV is negative. But we really want it, okay? What could we do next? What could be the next thing that we do to get this deal to work? What could we do? Very simple thing.
Negotiate.
We can negotiate, exactly. We could negotiate the price up or down. Down in what amount?
At least 35.
You got it. That's it. We would go back and we would renegotiate. You guys are good. Renegotiate the acquisition price down in the amount of the negative net present value. Okay? So if we can do that, and I can get 200 million, the asking price, and I can get a price reduction of $35 million, what's the net present value?
0.
And when my net present value is 0, do I accept or reject? Accept. Got it. So that's the first thing I can do, okay, if you can do it. Second iteration, third iteration. How are we doing on time?
About 30-ish.
Okay, cool. So third iteration. Go back to the board. We tried to get a price reduction in the amount of $35 million. We couldn't get a price reduction because the seller was firm at the $200 million. We can't get a price reduction. Well, Larry and team, we still want this firm. We really want this company. We need you to do what? They still want it. What can we do now? It's the third thing that we can do. Third iteration. What do we do now? The board really wants the company. The investment committee really wants the company. What do we do now? I'm not going to go back to the chairman of the committee and say, we don't want to do it. We're tired. We already spent 2 months underwriting this deal. We're not going to do it. And that's not going to work. So the board is going to want you to do what?
Make an offer?
And we already did. And we got rejected. Now what do we do? Now what can we do? Now what do we do?
Calculate a new intrinsic value.
Yeah, doing what? Using what? You're on it. You got it. What would we need to do to calculate new intrinsic values?
You could adjust your expected rate of return.
Got it. Okay, so let's go through the list. Okay, so we're going to review the assumptions. What I'm trying to do is go over this with you over and over and over and over and over and over and over again until you get it. And then you're still going to need to go over and over and over and again later on when you get out of here because again you forget stuff. So give me the list of the assumptions that we would need to reevaluate to come up with new intrinsic values to make sure that we didn't make a mistake. Do we make mistakes sometime based on the limited amount of information? And these deals maybe take about a month to underwrite. Do you think new information could have came in over the last 30 days that may have changed the intrinsic values, interest rates, or new transactions, or new growth rate assumptions? Yeah. So the expected return?
The expected rate of return is 30%.
Yeah, are we going to lower or raise the expected returns, both the terminal and the going in? You got to go back and look at the going in. terminal expected returns. So the question is, did we over or underestimate the expected returns? If we're getting a negative net present value, did we over or underestimate the expected returns? Were we too high or too low?
Underestimate, too low.
We were too high. Remember, when the discount rates go up, the present values go down. Okay? So we were too high because we got a negative net present value. If we lower the discount rate or the expected returns, the present values and the net present values go up. So we were too high. Okay? So we may need to reevaluate and see if we were too high. Okay? It may need to lower them. Okay? What other assumptions? And again, all the answers are right there. So go back and tell me what assumptions that we use to calculate the intrinsic value. Where else could we have made some mistakes?
Undervalued the growth.
Yeah, we probably undervalued the growth rate. And then what about the free cash flow growth rates? And we got going in, and we've got terminal. So did we over or underestimate the growth rates in the Gordon growth model and in the terminal valuation model? And where else could we have underestimated the growth rates? In the free cash flows. So we could have underestimated growth rates here, 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 here. So we could have underestimated them there. And we increase the growth rates, what happens to the present value? What happens to the present value if we increase the growth rates? Present value goes up. The net present value goes up. The internal rate of return goes up. The break even comes down. Okay? So we did that. So anything else? Any other factors in there? We got the discount rates, we got the growth rates. Do you think it would have made a difference if we had used a higher T equals 0 initial cash flow? Do you think that would impact it? If I raise this, what happens to the present value? Goes up. What happens to the net present value? Goes up. The internal rate of return goes up. Yeah. So we could have made a mistake here too, with the initial cash flow. Anything else up there that you see? Anything else?
Does the number of holding periods affect anything?
Theoretically, it shouldn't. It
Okay.
could, but I'm not going to get into that debate. I would say no, it
Okay.
doesn't. Okay, anything else? Okay, so you went back and you reevaluated all the assumptions within the intrinsic valuations, and you still come up with a negative net present value. And the board of directors says, no, we really want this company. We really want this company. So you need to go to the next iteration. Iteration number 4. And we'll go through this again using the investment decision-making matrix, which is the last, but I'm just doing it very quickly right now. So there's one more iteration that you can do. And I'm not expecting you to know this. Okay? And most people don't even know this. Okay? The fourth iteration is you need to calculate the value of the real call option. Okay? You need to calculate value real call option. Now they talk about call options, standardized call options in the book, okay, in chapter 20, okay, as how to value the call options. Those are quarterly, those are 3-month call options, those are standardized call options. Real call options are used in capital budgeting, okay? And actually the book doesn't even discuss augmenting the investment decision-making process, the capital budgeting process, particularly when you're acquiring firms, by using a real call option. And they are used theoretically, they are used in biotech, they are used in high tech to a certain degree. Okay? So it's a modern methodology of capital budgeting that augments the present value and the net present value calculations. Okay? But it's never really discussed much, which I think should be discussed. Okay? Because I find it extremely interesting as a methodology. So the call option, if you remember, you have some exercise price, which is your purchase price. And then when you buy the option, you have to pay some premium. And over time, your assumption is that the value of the firm, or the value of real estate, or whatever it is going to increase in value. And eventually you're going to reach some kind of break even, and then the delta between the purchase price and the value is going to be your profit. And here you're going to be in the money. This is called an in the money call option. And the time for these options are not 3 months, okay? They're 3 years, okay? These call options are 3 years. That's why they call them real call options. So that's a long period of time. And tell me about tech companies. Are tech companies, the valuations, stable or highly volatile? Highly volatile, right? Because they're plowing money back into the firm, and the valuations are really volatile. So you get these volatilities in the values, and then what happens? You know, these valuations go straight up once the market realizes the true cash flow growth rate potential of the firm. Okay. So when you're valuing these real call options, there's basically 3 factors that drive real call option values. The first is management decision. Do we acquire the company now, or do we wait? Okay. Do we do it now, or do we wait? That management, the capability of management to make those kind of decisive decisions at strategic or tactical time periods has value. Okay. The other is time value. Since we're looking at incubating this firm and restructuring it and maximizing the value, it's probably going to take us a year or 2, maybe 3 years to maximize the true value of the firm. So the longer the time period, the greater the time value, and that contributes to the value of the real call option. Okay. And then the other one is value volatility, which is the volatility in the valuations. Increases the probability that you're going to be significantly in the money in the future. That's why these venture capital and these private equity firms love high-tech companies, because they know that there's huge volatility. They're willing to pay that negative net present value as the premium to buy these real call options with the probability that they're going to be significantly in the money in the future. Okay? That's how they think. Okay? So this is a methodology that basically quantifies, and you can actually calculate this stuff. The value of these real call options using what's called a Black-Scholes, or a binomial tree. For those of you who go on and do master's degrees in business administration or finance, you're going to probably use some of those quantitative analytics, either in R, Python, or Excel or something. These are basically the mathematical techniques that you would use to value the real call option. Okay. So let's say we go ahead and we model this out and we calculate the value of the real call option. Okay. So the question is, what is the value of the real call option need to be to get this deal to work? What is the value of the real call option need to be to get this deal to work? Does anybody know? What's holding us back right now from accepting this project?
The net present value.
the net present value. So the net present value right now is negative by how much?
35.
35 million? What do we need to get this project to work on a net present value basis? What does it need to be? What does our net present value need to be to accept this project?
0.
0. Got it. So what does the value of the rail call option need to be?
35 million?
35 million. Got it. At least 35 million. So if the value of the real call option is 35 million, and your net present value is negative 35 million, then your net present value is equal to what? 0. And do you accept or reject it? Got it. What happens if the value of the real call option is greater than the negative net present value? Then the net present value is going to be positive. And do you accept or reject it? Got it. And if the value of the real call option is less than the negative net present value, then your net present value is what? Negative, and you accept or reject it?
Reject.
That's it. And then we'll do that again and again. We'll do some securities analysis. But that's basically the methodology with the real call option, augmentation of capital budgeting decision making. Okay? I'm not going to grind you through on how to get these EBITDA calculations because there's a whole pro forma income statement that you've projected out right up here. That's for your accounting class. I'm just trying to take you through the methodology. Okay? So I'm going to end it there. And then I'll work with anybody in regards to their deliverables or look at your memos or any of that stuff. Okay?